Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have George Milling-Stanley, chief gold strategist at State Street Global Advisors, to discuss the outlook for gold in the second half of 2023 and the allocation investors should consider when implementing gold ETFs as part of their portfolio. George, it's great to see you as always. Welcome back to Trade Talks.
Thanks for inviting me, Jill. Always good to see you too.
Thank you. GLDM just turned 5 years old and has quickly become the third largest gold ETF in the market. Can you tell us what has driven such strong demand in the product?
No, I think it was the right product at the right time. We at State Street, we became aware about 6 or 7 years ago of a general trend across the whole universe of ETFs, not just gold ETFs, toward lower share prices and lower expense ratios, partly as a result of the laser focus of the regulators on fiduciary responsibility. And we wanted to offer investors a product in the SPDR family, right? The State Street family of ETFs that would meet those criteria. GLDM was brought to market just 5 years ago, and it quickly has become a $6 billion product. Now, that's still nowhere near the size of GLD, the first gold ETF we brought to market 18 years ago. But nevertheless, that's a $60 billion product. But nevertheless, there clearly was a niche for GLDM. Investors have embraced it with some enthusiasm.
Let's talk about GLD, the leader in the gold ETF category. How is it different than GLDM? Are they two separate products for two separate types of investors?
Yeah, in many ways, that's the ideal way to put it. I think it really depends on what you want to do with your gold allocation. Some people want to trade a gold allocation regularly. They do it on a tactical basis, so they want to be buying and selling on a regular basis. Those people also want sometimes to rebalance in order to maintain a fixed percentage of gold in the context of a balanced portfolio. Those people need GLD because their lower trading costs offset the fact that the expense ratio is somewhat higher. But if you're an investor who simply wants to put a certain amount of money into a gold allocation and then sort of put it onto one side, keep it as a cushion, knowing that it's always going to be there, and you don't want to rebalance it, you don't want to take advantage of the low trading costs that GLD offers, then GLDM is probably, for the simple buy and hold investor, probably the best bet. And I think that's really the division between the two, Jill.
In honor of GLDM's 5th birthday, you recently conducted a gold ETF impact study designed to better understand investor attitudes and behaviors around investing in gold. Can you talk to us about some of your key findings? Did anything surprise you?
Yeah, key findings, I guess, would be that almost 90% of the people that we talked to said that they plan to increase their allocation to gold within the next 6 to 12 months. That was a higher number than I had expected. I'd expected maybe around half, but almost 90% was a huge number. So I think that's important. It was very interesting that 3/4 of respondents said that holding gold improved the performance of their overall portfolio. The biggest surprise to me, I've always kind of thought that people my age and older, and this has been all of my life, so even when I was younger, but the people my age and older were the ones who really got gold and wanted to allocate to gold. And I was surprised to see that millennials have finally overtaken my baby boomer generation. They are even more enthusiastic about owning gold than we are, and certainly than Gen X is. On average, millennials have a higher allocation to gold at around 17% of a portfolio, and that contrasts to about 10% for both boomers and for Gen X. The other thing, I think that more millennials than boomers and Gen X believe that gold ETFs are the best way to invest in gold. And that was at 69% against 55% for boomers and a mere 35% for Gen X. So the torch, if you like, is being passed from my generation onto the millennial generation. And I think that's a very healthy sign for the future of the gold market.
Yeah, totally bypassed my Gen X generation. That is interesting to see. What is your outlook for the price of gold as we officially enter the second half of 2023 next week?
I'm expecting prices to improve. We've had a little softness in the price recently, partly because there's been a recovery in the dollar as markets are starting to take Jerome Powell seriously when he says he is going to continue to raise interest rates. The pause in June was a hawkish pause rather than a dovish pause. In other words, he made it very clear and has made it clear in subsequent conversations as well that he plans to raise rates higher than anybody expects and keep them higher for longer than anybody expects. I think the markets had kind of been rather optimistically hoping for a pivot to rate cutting before the end of the year. But Jerome Powell's been pretty firm on that he's not going to do that, and that he is going to continue to be driven by the data. The PCE data that we saw this morning suggests that core inflation, not necessarily the headline, but that core inflation remains more than double the level that Jerome Powell wants to see it at, and the whole Fed Open Market Committee want to see inflation on PCE down at the 2% level. And here we are still well above the 4% level. So he's going to continue to raise rates. But basically, I'm expecting the markets to absorb this news. I think it is gradually being priced into the market that he's going to continue to raise rates until next year, and possibly even during next year, that we're not going to see a pivot anytime soon. The markets really need to get that lesson, and then I think that gold's going to recover.
I would agree with you. He's been pretty explicit in his strategy and focusing on core. Is there a certain allocation level you recommend for all investors to consider when implementing gold ETFs as part of their portfolios?
No, there's not one level for all investors. I mean, investors have very, very different time horizons. At my age, for example, I have a much shorter time horizon than, may I say, yourself. I think that whereabouts an investor figures on the spectrum of investing is going to depend on his risk tolerance, liquidity needs, on all kinds of other different things. What I do say, though, is that all portfolios, and I agree with the research on this, all portfolios can benefit from an allocation to gold. The research we've done suggests that somewhere between 2 and 10% makes sense for any portfolio, is going to improve the risk-adjusted returns. It's going to lower the risk and improve the returns. And there is another body of research that says if you are expecting, or if you were already in, times of exceptional turbulence in markets, it can make sense to double the allocation. So we're looking, the conversation becomes somewhere between 2 and 20% makes sense for all investors, and exactly where a particular investor fits on that spectrum depends on his or her risk tolerance and liquidity needs, essentially.
All right, George, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.